really develop the product. And the video changed over time. He modified it based on what feedback he was getting. And that was his MVP, was the video of what he thought he could develop in terms of cloud storage, which ended up in a very successful company. Take another one. Yes.
I was in the news plus, but just taking it as an example, what about the copyright? Like, what if someone else took your idea before you build it up? Like, how can you manage that?
Well, let's step back and give you one of my fundamental precepts. You can never protect ideas. You can protect inventions with patents. You can protect processes like trade secrets, but good ideas are for the world. And people, if you're far enough ahead with what you're planning and what you're doing, it's very difficult for someone to catch up. So I know that a lot of young people who have ideas get paralyzed with trying to communicate their ideas to other people because they think it'll be stolen. That is a lot of, sort of self-ego saying what I got is the best and everybody wants to steal from me. I would be careful. I wouldn't, go into a Zoom call with 100 people in China. Well, because the likelihood is it'll get reverse engineered pretty fast. But I would not be paralyzed into protecting my idea. And that's what Drew Houston did. He went out with a video and showed it to everyone and says, this is what I plan to develop. And you got signups. The next case is the same. Zappos. You all know Zappos, right? The shoe online company, the Amazon for shoes, turned into a multi-billion-dollar company. Amazon itself is a good example. But Jeff Bezos with books. I mean, he was a neighbor of mine in Mercer Island, Washington. And he would load his books up into the back of his SUV and drive to the post office to mail. And look what Amazon has become today. But it was that MVP. And then somebody like me who was offered the chance to invest in Amazon at that time turned it down. It's one of the dumbest mistakes of my life. My thought was, who's going to buy books online? You got to go and open a book on a store and sort of read the first couple of pages. I was wrong. Jeff Bezos was right. But he did it by trialing it, just like Nick Swinman did with Zappos. Great success story. Minimum product. He went out, took pictures of shoes in various stores, put them online, people ordered. He says, now I got a business. Making sense to you guys? You have some questions.
No, I just you wouldn't be here. We wouldn't get free pizza at the end of the day. We invested in Amazon.
No. I've been lucky elsewhere, but this one was a dumb one. I've had my share of mistakes, but some luck also. So the lesson from this is don't guess what the customers want. Because some of stuff I'm hearing, even in this room, is a little bit of guessing what the customer, intelligent guesses, but a little bit of guesswork. Don't guess what they want. Test it with the smallest experiment possible. Does that make you speed up your hope that you will be a company in 5 to 7?
Probably.
Huh? I hope. I mean, what you guys are doing, it should be in the marketplace quicker than that. And the metrics that matter are important. Actionable metrics. I talked about vanity metrics. So don't worry about vanity metrics. Things like what's the cost to acquire a customer? What's the retention rate? What's the revenue per use or revenue per widget that you sell? Those are the things that are important. Like one example I like to give is you launch an app. Again, this is app-based because everybody uses apps. And you get 100,000 signups. But within your week, you only have 50 people using it. Didn't matter, right? And here's the hardest decision for most people. When do you pivot and when do you persevere? And some of this comes from gut, some of this comes from customer feedback, some of this comes from initial success, and much of it can also come from advice of your coaches and mentors. Don't forget that in your entire process. If you've got good mentors, consult them. Don't be afraid to say, look, I don't know. Could you help me? Yeah. All of this may sound pretty self-evident, but pivot is a structured course correction. And in lecture 8 or 9, you're going to hear from a gentleman by the name of Anthony George, who has a company called Fuel Tracks, which is probably going to exit around $500 million pretty soon. But there were twice in the process where he almost went out of business and he had to pivot. Sorry. Anyway, and some of it will be gut. It tells you when you persevere or when you have to pivot. But pivoting oftentimes comes when you absolutely run into a brick wall with what you're doing. But you still feel very much that the idea you have or the technology you've developed has a place. But then let customers tell you that. The whole approach of lean startup is not just for 2 people in a garage. It's for even large companies who should be using it. And Chevron Ventures is a good example. David will talk to you about how they use housing the concept of lean startup within the giant bureaucracy and politics of a big company to hopefully do things faster, quicker, better. So the closing and takeaways of this session is that don't fall in love with a problem. Don't fall in love with your idea. Fall in love with the problem you're solving. Make sense to you all? Whole concept of a lean startup. It's not about it's about reducing waste. Sorry, not just money, but time, energy, and passion, and cycling back what you learn to improve what you're doing. And finally, the whole object is to sell your product and make some money and exit. Right, that's the last step. Like I like to say, the biggest risk is not that you fail. The biggest risk is we succeed at building a product nobody wants, or very few people want. Like I would say, the favorite example I like to give, because I started off in that business 55 years ago, is the world of telex. Does anybody remember what telex is? You should go back and just do a Google search on telex and just see. It's the original communication method. Remember the movies you see of punch tape coming out of a reader in World War II movies? Clickety, 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 with all kinds of holes punched in the tape, and they insert the tape and they read it out. Well, that was telex. But it was invented really by the German army to communicate with the front lines. And it was the basis for worldwide communications till the early 80s, till fax replaced telex. You had only 31 characters you could send, all uppercase, 26 uppercase, and stop and comma, and that was it. But that's the way the whole world communicated till the early 80s. You folks all now can use this with all sorts of power, but the reason I bring up that is today, if I built the perfect telex machine, nobody would want to buy it other than collectors. So we could have we could have built the perfect product, but we would fail. So interviewing techniques. So let's drill deep into this one portion, the first part of the lean startup, which is to interview, get feedback, and get a basis for improving, modifying, or pivoting your product. You got to define your guesses. Who is your customer? What problem do they face? How are they solving it today? Like you all have talked about, versus what you can do. And how much is that costing them? Right? Then you talk about, to be able to do this, you got to get out of the building. You got to get out from behind your laptops. You get wear out some shoe leather. Talk to customers face to face. Yeah, Zoom is fine, but there's nothing like face to face if you can get in front of the potential customer. Let's say approach with curiosity, not a sales pitch. You're not selling your product at this time because you don't have one yet. It may not even be at the MVP stage. It's maybe just at the idea stage. And some examples of questions I would think you should ask. Walk me through the last time this problem occurred, the one that you were trying to solve. What solutions have you tried? What happens if this problem is not solved for X number of months or years, such as what you're doing? All of you. There's many mistakes you can make. People are always polite when you interview them, and they will say, hey, that's interesting. Interesting doesn't mean that's great that I'm going to use it. So they're going to, so look for evidence that they've tried to solve the problem, because that's very important. If, for instance, in your cement people, have they tried to solve the problem? The carbon recapture?
Trying to do it in different ways.
Okay.
But I know that there are like 2 companies right now that are also service but are doing something similar to us.
Okay.
And some companies are working.
Well, that's also validation sometimes if someone else is doing it.
Yeah.
That there's potentially a marketplace. It may not be the only validation, but it sort of gives you some level of comfort that you're not, out there outrunning all the supply lines, way out in front of everybody else. Yeah, that's why sometimes the first mover gets all the arrows in the back. And the fast follower sometimes is more successful. When you're interviewing, check for the emotional body language. Does that problem cause them frustration? Is there a sense of urgency in which they respond to your questions in the interview when you're asking them about the problem you're trying to solve? And also try to get from them, have they allocated any budget to solving this problem? Because mostly you're all going to be trying to sell to larger companies. You're not going to be selling ads to people at $2.95 a month. So, for instance, I try to come up with an example here for an oil field drilling superintendent saying we're losing $500,000 a year due to unplanned downtime, and corporate is trying to get me to find a solution, which then says, I have a window of opportunity here if I can reduce their downtime when they're drilling. Then you drill it, unintended, into what's the reason for their downtime. Test the problem and the solution. So see if they're going to commit. We're going to talk about, I think last lecture I talked about several companies that went with their MVP and then had potential partnerships. We'll talk about another one at a very early stage, and that allowed them. I have to take this, guys. I'm sorry. Do you want to take over?
So why don't I just kind of introduce myself? So I get that out of the way. So Dave Dreesen, I work for Chevron Technology Ventures. Fairly new at Chevron. I've been there 2 years, a little bit over 2 years. My background is really, I feel really old now because it's 30 plus years all in sort of climate clean tech area. I started my career with the nuclear Navy, which actually wasn't climate or clean tech back then, but it's become clean tech. So now I can say my whole career has been climate clean tech. I got involved after my Navy gig, which I was at the headquarters organization, Cradle to Grave, for the nuclear power plants. I want to stay in energy, but I was really interested in software. It was the mid-90s. Joined Anderson Consulting and got involved with the deregulated power markets in California, and very quickly split out from Anderson and started a company called the Structure Group. And I put a case in there for that. We did MVP very well at Structure. I was doing that. It was going great. It had gone from 4 of us to 50 in like the first year. I was doing business school at night, And it was 99, and I was, everyone wanted to get into venture capital in 99. This was pre-dot-com crash. And I thought energy and venture capital would be a really interesting area. So there was two groups doing that. One happened to be in San Francisco, and I had the great opportunity to join them in 99. So it wasn't even called clean tech back then. It was, we were strategic fund. Yeah, mostly electric and gas utilities, and also Chevron was an LP. So I got to know Chevron back then. And you're ready to come back?
I'm ready to come back. I'm sorry, guys. This was a bit of an emergency, but he'll be on. He'll be on, and be more interesting than me. So we'll get to him quick. So more interviewing techniques, common mistakes is that you tell them your idea. You're not asking them about their problems. You learn less when you talk more. So let them talk. Let them tell you about their problems. Let them tell you what you would like. And don't ask them, will you use this? Because they're most likely in a polite way say, yeah, sure. When it's done, come back, let me see it, and they'll use it. Focus on the real pain points and do not ignore negative feedback, because most of us just want to hear great idea, good things. You want to hear good things about yourself and what you're doing. Don't ignore the negative feedback. Just make sure you incorporate it into your thinking. And the goal is to learn, not to sell. You'll sell your product later on when you have it out in the marketplace. But right now you're trying to, this is the very early stage of your company where you're doing customer discovery. And in customer discovery, you've got to be able to build the MVP that allows you to test it in the marketplace. And finally, the core, you should be, I'm just saying, here's an action challenge for you guys. Next week when we get back, at least get back to me with one customer interview. Homework. And I'll read it. I need to be able to get on canvas though. Study. Flutura. They're a really successful company now. I don't know if you've heard of it. They're in the oil and gas business. They originally started off with an idea of software, IoT analysis and sensors to give companies analytics for energy efficiency, energy usage. But when they went and talked to plant managers, heads of maintenance, and reliability engineers, they found that people weren't interested in that. What they were interested in is predicting when certain key items in their rigs would fail. They wanted predictive analysis, like this valve is going to fail in 6 months. I mean, of course, it's not certainty, but there's certain probability by using past data, so that before the valve failed, they would go replace it. And now Flutura is a hugely successful company. They're almost in every oil drilling rig around at least around Texas. And they did it by pivoting. They did it by customer interviews, by talking to all the people, because they had this idea that, hey, we're going to come up with this software package that's going to solve everybody's problems. And it wasn't. It was completely the wrong way. So they pivoted, refocused, went into predictive analysis, and now are successful. That's something that you guys think might happen to you? The high pulse battery thing? So don't shut your mind to it. It's very important. And in the energy business, it's even more difficult because they're large businesses, huge dollars spent on assets. The regulatory requirements are quite high. In medtech, they're high. And it's very important to have early stage pilots and demos with companies to be able to validate what you're doing. Very asset intensive world, the energy business, one drilling rig is $200 million, right? Wildcat one. So you're talking not two guys in a garage developing an app. So there's also the big area for entrepreneurship in the energy world, because you're so dependent on the energy giants, Exxon, Mobil, Chevron, Shell. So some of you might end up in that world. Not every PhD student working on a great idea is going to build their own company, but that doesn't mean you can't be entrepreneurial. And that's what David's going to talk to you a little bit about. And it's all about Chevron innovation. When we think of, startups, like I said, we think of two guys in a garage, which essentially Steve Jobs and Steve Wozniak built Apple. Today, arguably the world's most valuable. Well, I think Nvidia has gone past it, but top three most valuable companies on earth started by two guys in a garage in the late 70s. That's what we think when we think of startups, but that doesn't always have to be the case. Because when you think of very large companies like Chevron, they've been around 150 years almost, 140 years. I think they went public in 1890 something. I know that the Pillsbury, the law firm that took them public, has that certificate as you walk in their office in Silicon Valley. So how the challenge for these big companies is how do you harness the agility, the nimbleness, the creativity, the speed of entrepreneurs, the two guys in a garage, in the context of this very large, bureaucratic, political, sometimes, company. And some companies have learned to do that. And that's what exactly Chevron Innovation does, Chevron Ventures does. And for the rest of the session, you got the man.
Thank you. So I guess I'll continue with my background and then dive in. So I ended up spending 12 years in venture capital. I was in Power for 7 years. Then I went to Battery Ventures. Battery Ventures isn't actually focused on batteries. It's a generalist firm, and I was hired to basically kick off the clean tech practice there. So I spent 12 years through 2011 in venture capital. And then I was on your guys' side of the table, I guess, if you're starting companies. I was an entrepreneur for sort of a decade plus, CFO of companies, helping raise capital, started a couple companies, and really decided I wanted to get back into venture capital. I think a lot of the drivers around climate have changed. I think created a really outstanding opportunity. I think the next 5 to 10 years are going to be really interesting time to be in climate and trying to innovate there. Companies like Chevron, I mean, scaling was such a challenge last time. I think companies like Chevron can really make a big difference. As we look at addressing our own operations or existing operations and also looking at sort of building out new businesses. So, and then, like I said, 2 years at Chevron. And I have kind of the overview picture here. I'm part of the innovation team, part of Chevron Technology Ventures. Broadly speaking, we have internal innovation, we have external innovation. I'm part of the external innovation team, and that's kind of, think of it as 60 of us in Houston, sitting in an office building, right? And that's, you'll see that's much different than our internal innovation. Within our external innovation, think of it as a third kind of venture capital. We have a core fund. How do we improve our existing sort of oil and gas operations? And a future energy fund. How do we create new great opportunities? So, Sony created PlayStation. That ended up being a huge opportunity for that, right? Amazon created Amazon Web Services. Can we be plugged into what's going on with innovation, find, that next great opportunities for Chevron to build its business? Companies like, Blockbuster Video didn't do things like that. We know where they are today. So, we have a great business on the core side, and we want to, look at building great businesses in the lower carbon economy. I'm really glad that the customer and the lean startup are sort of grouped together. I think those two things really form the core of being successful at getting innovation successful anywhere, whether it's something we do internally or something externally. It's really challenging. What's going to get overlaid here is resource constraints, right? If you're wrong about your customer, if you're not using the lean startup principles, you're going to make mistakes. You're going to run out of capital. If you're doing it internally, you're wasting resources instead of, and you have your own metrics internally. So, it's part of the puzzle, but it's really kind of the core is understanding, who your customer is and then executing well on a strategy there. And obviously that has to fit into on a entrepreneurial has to be fit into the right business model as well. So it's not just about getting there; it's about getting to ideally the right place. And we put in one example that we have chatted about that. So for Chevron here, our customer discovery for internal stuff is a little easier. We are the customer, and so we have downstream, upstream, Chevron New Energy. So that's a group that's established a few years ago with many billions of dollars to look at building out businesses in the lower carbon economy. I'm part of the Future Energy Fund, and they're a little bit more our customer, whereas the core fund, it's more downstream, upstream, midstream. But we also have groups that have expertise in specific areas, and those are also our customer somewhat. Chevron as a whole rotates people through different operations. And so there's a lot of knowledge, within our venture capital group in these different areas, or people have rotated maybe through the venture capital group or Chevron Technology Ventures, and now they're back in another place within the corporation. So you can sort of build out that sort of culture of innovation and awareness through that sort of rotation side. And then I would say innovation for Chevron, it's key. We're looking to increase our profits and lower the carbon intensity and create new opportunities. And so, that's innovation is pretty fundamental. What's some of the best ways to increase your profitability or create new business opportunities? It's using technology, using innovation, right? And we've been very successful at that over the years. In terms of internal technology, we have various groups. The sort of hub of that is Richmond Technology Center, and that's 800 people, 36 buildings, 1.2 million square feet. It's got a lot of laboratory facilities to evaluate things, lean startup principles, understand what the customer is, evaluate things sort of at the bench scale, but then we also have piloting capability to advance that sort of to the next stage. And RTC's more, and as well as RTC's more on, call it the chemical materials, catalysts, fuels, engine technology, lubricants, things of that nature. And I'm going to shift, I'll talk about some of the other facilities, but that's sort of internal technologies. External technologies, instead of that big building with all those labs and all that capabilities, that we're sitting in an office building primarily, right? And so what we're doing is we're trying to get leverage. We can do stuff internally. We want to know what's out there externally. There's a lot of great minds, a lot of great companies. And so for us, we want to excel on both the internal and the external. What you see on this diagram here is you have a funnel that's sort of this use pipeline, and that upper funnel is the venture capital piece. So there's a lot of great ideas, great companies, breakthrough concepts in the venture capital area. And those are a lot of times, so there's a big ideas, they need capital, so they're going to go raise venture capital. And so we definitely want to be connected with that, and we are with their core fund. in our future energy fund. Some of those you can see in this area we may be using right away. The core fund, a lot of times that's the case. In the future energy fund, we've invested in fusion. We're not using fusion today, and we haven't piloted fusion. It's not there yet, but we want to know what's going on there. We want to be tied into that, and so that maybe that does create an opportunity in the future, or maybe if it's not something we're specifically doing, that will impact our business in some other way, where we're strategically making right decisions earlier on because we're kind of plugged into that. So that should provide, I guess, some context. One facility I wanted to bring up is the Cannon that's located here in Houston. That's unlike sort of a wet lab. It's a Metatronic facility. So it's really looking at bringing in mechanical engineering, electrical systems, software, automation, and how does that sort of potentially impact our business? And so this is great because we can have early stage ideas and we want to go deploy those. It could be a sensor, it could be a new take inspection system, it could be drones, it could be robotics to sort of keep, map out different areas. So rather than if you try to go test that in the field right away, again, lean startup principles, understand what the customer wants. And maybe we've made an investment. If we go put that in the field right away, we have a really demanding customer. Again, voice of the customer. What does your customer want? They have their operations, they have their metrics. They're trying to excel at their downstream operations, at their upstream operations, right? So we as an innovation group, we want to advance these technologies and we want them to make a big difference for the company. But if we throw things out and are not iterating, then the customer's going to have bad experiences. We're certainly we don't want to disrupt operations, and safety is core to what we do. And so, hey, let's try it out here at the Cannon. Let's run it through cycles. Let's go back to this startup company and say, hey, here's what we found. We're having connectivity issues, or it's not presenting the right data. So this is part of our lean startup approach, and this can apply to both internal and external. And RTC can both do more internal and external. But a lot of our core expertise isn't as much in drones and sensors and automation and cybersecurity. That's not our roots. A lot of that's more external. So the Cannon forms a great bridge for us to be able to basically go through the lean startup cycle on getting products tested, and then we can go into the field and have a much smoother process in the field. And if you, the history, at least on software, is, you catch something in the code, it costs you 1. You catch it sort of in testing, it costs you 10, and you put it in the field, it costs you 100. I think that generally applies. So the more you can solve things earlier, the better. I guess that's sort of just kind of closing out. So that I have some, that's sort of the Chevron ones, and I'd like to talk a little bit about some Chevron cases, but I also, in prepping for this, I thought about some of the key lessons learned over the years. These are sort of pre-Chevron. What I would say, and Ashok mentioned it a couple of times, this all seems self-evident and obvious. It's amazing how often this is screwed up and how big of a difference it makes. I'm going to add another, I'm rambling a little bit, but I'm going to add another layer which is if you're raising capital, who's your customer at that time?
Answer. Yes.
Who's your customer when you're raising capital? What are you selling when you're raising capital? You're selling shares in your company, right? So who's your customer for buying shares in your company,
Bingo.
right? So there's another layer of who your customer is. So if you're going to get into raising capital, make sure you're thinking about, okay, all the elements of who your customer is, but also, team, tech, TAM, timing are the 4 T's. And then if you want to expand it, it's 10x traction and transaction. So there's 4 T's and there's 7 T's. But the bottom line is most of those T's, what's fundamental is who your customer is that you're ultimately selling your product to. When I'm going through a due diligence process, that's core. That's going to tell me, well, how big of a market is there really? That customer interaction is going to be, how much better is their solution than other solutions, than what you're doing today, or who else is in the marketplace? Who's the decision maker? How hard is it going to be to get this? What's the process for getting it in? I'm going to ask all those questions in my due diligence. And so if you've done your job, you've prepped up customers so that when I call them, ideally you prepped your customers, you have good customer engagements, and you can tell me exactly what your customers are going to tell me. And then when I call, they validated that. And so I'm like, this team knows its customer, and they're thinking about, and they're assessing the customer in the right way, and they're being realistic about the customer. And I know that this is going to be a process, and that you're going to need to be plugged in, intentionally pivoting or evolving the product. So it's not learning the customer. Yes, it's going to help you with your product. It's going to help you design the right, understand your value proposition, where you're differentiated, but it's also going to speak to the model, and it's going to help you raise capital. And then once you raise capital, when we invest, all of our portfolios, our companies are, this is going to come down to, again, back to the lean startup. What are you going to accomplish with a little bit of capital that's going to allow you to raise more capital, typically? And I have to be convinced that if you're successful in that, I should invest now. I shouldn't just wait, right? Because if you're successful, the valuation is going to be up and it's going to be higher. And so I want to get in early. So anyways, I can pause there before talking maybe about a couple cases.
Chevron Ventures, on the possibility of some of you incubating there.
So I have a question. So where does Chevron business strategy stand at the moment? I'm asking because it's axiomatic that with the volatile oil and gas and derivative market right now, Chevron core business strategy aligns itself with the changing market dynamics. So where does this future energy ventures is aligning itself to invest at the moment?
So one that sort of venture capital in general is it's the Wayne Gretzky. You want to skate don't skate where the puck is, where the puck's going to be. And that's kind of our task on the future energy side specifically. So if you're asking about the venture capital group, we're looking for great opportunities that, create opportunities in the future. We're actively investing. We've closed a number of very interesting investments this year. We're still in the market looking for more great ideas. In terms of Chevron New Energies, you know, I think the initial focus has been more on hydrogen, carbon capture, storage, utilization, offsets. We still have activities in all that area, but we've also launched initiatives in lithium, and we've launched initiatives in the power business. So we produce a lot of power ourselves. Now, the reason we produce power primarily is because we need a lot of heat for our operations. And when you have heat, a great thing to do is produce power with it, right? If you do combined heat power, you're at like 90+% efficiency, or value you're getting out of it. So we have a lot of expertise producing power for ourselves now with data centers needing a tremendous amount of power. You know, that's an opportunity where, you know, we think our skill set fits particularly well. So we have, you know, initiatives in that area. So, you know, Chevron's been in, even if you talk about venture capital, innovation's core to Chevron. Venture capital, we've been consistently doing it for 26 years now. Other corporate, the average life, I think, of a corporate venture capital group is 3 years. You know, it's, hey, things are going well, we have a bunch of cash, let's get into venture capital, the market's hot, they invest, the valuations are high, there's a turn in the market, you know, let's get back to basics and get out of that. So Chevron's very committed to innovation. As we talked about, internal and external, you want to be plugged in with both. Venture capital's a really great way to be tied in on that external, you know, in a meaningful way for, you know, not a huge amount of dollars. We don't have you know, all the lab facilities and all the PhDs, you know, we're just kind of plugged in. And if we do our job well, we invest, we learn a lot. Maybe creates great opportunities for Chevron. That's our hope. And we actually make money doing it, right? So it's a very, you know, good thing to do. We have our future energy fund, core fund, had 1999, did sort of climate investments out of that. In 2018, we said, hey, this is big enough of an area, let's have a dedicated fund. And the mindset's a little different too for our group. The core fund's really how can we create value very quickly for our core operations, and then looking a little bit more out to the future, but it's a little bit culturally, it's a little bit different mindset when you're looking for, hey, what's the next big thing? Who's your customer? Sometimes that's a tough question. You know, we invested, it hasn't been announced yet, but in a sort of cellulosic biofuels play that we think is really interesting. Well, who's the customer for that? Who do you talk to? I mean, it's a little bit like the ethylene one, right? You know, you have a large market, it's a commodity market, it's worth billions of dollars. You know what the price is. You know, do I need to talk to anybody, or can I, if I just can make it cheaper? Okay, well, maybe your technology can make it cheaper. And so you can go talk to somebody and say, hey, if I can get lower carbon intensity ethanol, you know, would you buy it? And certainly you're going to look at incentives. In fuels, you have the RINs, you have LCFS, you have incentives that help with that market. But sometimes your customer becomes a little bit of, how are you going to commercialize this thing? Right? Okay, so you know, how are you going to get the capital? How are you this is challenging to do. So, you know, maybe part of who your customer is non-dilutive capital. Maybe it's an industrial partner that is looking to build something out. Is for you to get to your first million in revenue and then your 10 million in revenue, you know, who do you have to sell on what you're doing? And it may not be, you know, the person buying a gallon of low carbon ethanol. It may be a corn ethanol plant. It may be the DOE or the USDA or the Department of War, somebody that has capital and this is strategic to them. So who your customer is, it may be the end customer, it may be the partner, it may be your venture capitalist. You have a lot of layers of customer that you have to think about. So I don't know if that answers your question, but
It answers my question to some extent, but in a nutshell, I would assume the current focus of Chevron Ventures is predominantly towards hydrogen production, power generation, and carbon capture and storage. Not the restrictive list. I know the list.
yeah, so our broad sort of 4 pillars in industrial decarbonization.
Mhm.
Okay, so how does it, and this is where if there's a technology that we can deploy that helps Chevron decarbonize, and maybe we can take that and help decarbonize the rest of the oil and gas industry, the rest of the chemical industry. Maybe it applies broadly. So hydrogen put in there, carbon capture, storage, utilization. That would probably be more point source type things. Things in industrial heat or electrifying industry. That all sort of fits in there. Mobility. So that can be anything from new fuels, low carbon fuels, opportunities around that, battery technologies, charging technologies. And then there's the whole power side, electrification more broadly, decentralized energy. We have a number of bets that we've placed there. One this year in the power electronics side there, mainstream energies on the power generation side. We also have circular economy as an area that we look at. And so that's where some of the looking at the materials area is kind of interesting. I mean, in hydrogen, I think the area, it's a challenging market. The area from the venture side is probably focused more on the kind of subsurface hydrogen as kind of a next big thing. And so you're seeing more activity there versus the next electrolyzer sort of green play. So we try to look broadly. We have project areas in venture capital. You want project areas where you think there's an interesting opportunity, dig into those, but you also want to cast a wide net because entrepreneurs surprise you, right? That's part of what the external technology is. There's new things that happened. This one that I talked about already, that was different and better than anything I had seen there.
Thank you.
Let this.
Yeah.
So coming back to the business model question, I'm curious, at what stage does Chevron typically invest into companies? Is it like you reach a minimum viable product or maybe even earlier than that? And then following up with that, what are the typical timeframes that you look to expect a return on investment with these companies?
Yeah, so one thing we don't actually lead deals. So we look for high quality financial investors that are experts at building companies, at driving all these lean startup principles. If you need changes in management, that's something that the venture capital groups do. And so Chevron doesn't take a lead in doing that. That's sort of decided that that's not something that makes sense for us. And so that's a short answer to say, we kind of align with the same timelines that the top venture capital groups. Yeah. And we generally will come in from very early stage. I would say generally speaking, we tend to be a little earlier. If something's now that I'm speaking a little bit future energy fund, if something's so far along, then we kind of know about it strategically. Anyways, usually the valuation's much higher. You know, it maybe doesn't make as much sense for us to strategically or financially get in there. So typically anywhere from C through A or B is probably kind of the sweet spot. We're maybe $2 to $5 million investor kind of in a first round, and then follow on from there. We do have a very early stage program called the Chevron Studio, which we partner with the national labs to pair interesting technologies with entrepreneurs. And so, you know, that'll be a small dollar early stage thing. There's other deals where, you know, it's pretty early, and if there's a good group, lead group, you know, we don't mind putting, you know, $1 million in, or maybe even less, to something that's a really big idea. But if you're coming in really early, usually that's a, hey, this is a big idea type thing. Let's get in early. If it's, hey, this can be a pretty nice solution, and you know, it's not going to change the world, but you know, maybe it's helps us more, you know, be more intelligent strategically, or something we can deploy, then later stage, you know, that can fit as well.
Maybe,
We're not going to go into something that's not a big idea if it's super early.
yeah. Maybe one more thing I'll ask is, so because you're kind of focused on the external investment, does that mean it's limited to just financial investments, or do you ever, you know, partner in terms of like the technological contribution as well?
Well, so I'm a third of venture capital is a third of Chevron Technology Ventures, that external innovation. We have a pilots and deployment team. We have a tech strategy team. And so, you know, back to that, if we went back to that one chart, there's a lot of interesting technologies. Either maybe it's just a too high of a valuation and we don't want to invest, but if it's a great product, then I'm going to introduce it to our team to see if we can deploy it. You know, the big win for us is, you know, Chevron's a very, you know, profitable company, and our business model brings in that cash year after year after year. If I put 5 million into a deal and I get a 20x, and that brings $100 million, and that's great for our venture capital team. That doesn't necessarily make a huge difference for Chevron right down the road. But if we're, you know, looking at an area and it's creating an opportunity either for us to partner, or maybe we don't go spend a bunch of money or go down a path because, you know, there's something better that's coming along or whatever, then I mean, the real opportunity for Chevron is that next. It's the Sony's PlayStation, it's Amazon Web Services, it's, you know, it's creating those type of opportunities that can provide a business that's profitable year after year after year.
And remember, you're never going to get an investment from anyone other than the 3 Fs. Remember who the 3 Fs are? You're right, and pools. You're never going to get an investment from anybody outside of that group of 3 Fs without a full-fledged business plan.
Yeah.
We're going to talk about that later on, how to develop it. But the business plan needs to reflect all 9 steps that we talked about last week, from ideation to exit. And much of the latter half is your best guess, but with the financial model being a very important part.
So I did put just a few slides together on just a few that came to mind. One was the Structure Group. This was that company we started right at Anderson Consulting. This was building software for really bidding into, or it's doing settlement and billing for a generation company. If NRG or Enron or Southern Company back at this time, would bid into these markets and they had to do settlement and billing around that. And so we came out of Accenture and we were very tied into what the market needs were. And we thought that there was a compelling software product for this. So we basically designed it in what's called painted windows. So there wasn't anything behind it, but we sort of came up with the software product and we went out and we sold it. And so it wasn't just, we weren't going to the customer and saying, hey, customer, what is it that you need? And we can build for you. And we didn't even go and say, hey, we don't have a product, but we think we can build something for you, because we wanted to own the product. We didn't want to build it as a consulting software that they own. So, but we were a startup and we were doing consulting services, so we had income from that. We didn't raise any venture capital. And so in this case, we had a good sense of what the product was. We had the ability to basically design that product, and we sold that product to our first customer. And so they bought it, and then because it's software, we jumped on it, and then we built the product, and we went through the lean startup process, got them the product, iterated on it, sold it to everybody else in the market because it was the best thing out there, expanded from the California market to PJM and NEPL, and basically built out other markets. And so we built this great software product. We didn't raise venture capital. And it started with, not just asking the customer, but us knowing what the customer needed. And there's, you hear the Henry Ford example, if I ask customers what they want faster horses, right? So it isn't always, the customer doesn't always know what they want, or know what they really need. So, if you can figure that out, and certainly on the software side, just think about if there's value to be extracted, if you can approach that customer discussion in a way that's a little bit different than that's putting yourself in a position of strength on whatever your product is. There's you got to be careful with fake it before you make it. We know from Theranos and others that can go really bad. But it's just something to think about. And I think that works particularly well with software. This was a company when I was at Nth Power we invested in, and I put a couple of other lessons here under the other lessons. Maybe start with that. I mean, I put two. This was Jim Cramer in '99 did his companies that were going to be big companies in the next decade. And one of them was Plug Power, and the Plug Power stock went through the roof because of that. And these guys were making a zinc air fuel cell. And it was a really hot market. And they were trying to follow the lean startup principles. And they had the ability to, because of that sort of uplift in demand versus anything fuel cell at that time, and it was new and interesting, to raise a lot of capital. But they didn't, because they're a lean startup. And what's the traditional startup? Figure out what you need to do, raise just the capital you need for that, and then hit milestones, valuations higher, then raise more capital, less dilution, right? But if the market's hot, be realistic about your value of your company and where that market is. And if there's an opportunity to raise capital, sometimes go ahead and take that.
We have a whole section in one of the future lectures on raising capital.
Okay, good. I won't go too much there.
No, that's okay.
But
I will give you one little addition to what David said very well is, yes, lean startup says, don't raise too much, but I have a theory from 55 years of being beaten around the head and shoulders repeatedly. You can never raise too much.
But just
Money's
because
there, most likely take it.
And so some very good companies have raised a lot of capital because climate was pretty hot. but they still followed their lean startup principles. They didn't go blow through all that capital. So, that's a real risk though, is you raise a lot of capital, you stop being a lean startup and you go blow through it. And now if you haven't really created a lot of value with what you raised, if you run out of capital and you need to go back to the market, now you're sitting in a bad place. You're sitting in probably a recap type thing. So, it's okay to if the opportunity presents itself, you think it's reasonable, don't just raise the bare minimum, but still be a lean startup if you do. The other, in this case, this was the company needed to make progress on a little bit of capital, and the board said, the company came back and said, hey, we can build the next version, get a commercial for X dollars. And well, that's not good enough. You got to do it for less. And then they came back and did it again. No, that's not good enough. And eventually, guess what? The company came back and voila, they figured it out. Right? So you can do a lot with spreadsheets. So a gun to the head of a startup with a spreadsheet, and if you can't do it, that can create something that's just not possible. So that was a lesson learned from this. Was early in my venture capital days, and I saw the impact of the board because I went in as the interim CFO because right after we raised capital, it's pretty clear they were going to need more capital. Surprise, surprise. So I went in there and the first thing I did was a really thorough, these guys basically zinc air, rechargeable, think of it as a battery, potentially low cost, scalable, so you can have a big tank, long duration stuff. This company actually still exists under a different company's name now. So we did a bunch of work. I started with a customer and they were building a 2.5 kilowatt system. And guess what? 2.5 kilowatts was too small. The customers needed 5 kilowatts. So this was a company, and there's always a challenge because you can build a 2.5 kilowatt, improve things more quickly for less dollars. But if you're trying to get it into the market, then you got to start over again. And this is much different than software. Now, companies like Tesla and SpaceX have challenged this concept that you can sort of iterate through things, hardware stuff, more quickly by doing it in-house, quick, rapid fail, but they're still using lean startup principles. But lean startup principles, when you have a hardware product, is different than when you have a software product. You can't do what we did with the structure group, with metallic power. So if you're going to build a product and set out to do that, make sure that it's your minimum viable product. Make sure that when we discuss it, make sure it's viable, because your next round of funders are going to, want to go to customers and where's your orders? How's the market like? Oh, well, now we're going to go, we proved out it works. Now we're going to go to 5 kilowatt. Okay, well, how long is that going to take? That's going to take 2 years. Because that's a it's like, well, couldn't you just done a 5 kilowatt? Yeah, but that would have cost a little extra. Yeah, but now you're carrying the company an extra 2 years to get into the market. And that's the key value creation, is to get something into the market. So make sure your MVP really is an MVP. This was a company, STM Power, Stirling engines, really interesting technology, kind of external combustion. So versus a typical burn the fuel inside, it can take heat from the outside. You can use any fuel. This was a play potentially for winning low cost solar back then, believe it or not. Panels were a lot more expensive than they were. $5 a watt, not 12 cents a watt. And so these guys went to commercialize a Sterling engine technology. And they wanted to make a big splash and be really bold. So they went to, let's get this commercial as soon as possible. And so they built 50 of these units, 25 kilowatt units. And I put nail it before you scale it, because this has, again, we're back to hardware. This has a really challenging seal problem to solve. So this basically have to move back and forth based on temperature, and the working fluid is either hydrogen or helium. In this case, it's hydrogen. In this case, they're using hydrogen. You have to make sure that doesn't leak out. And what leaks out? Okay, now you've spent a bunch of money. Well, how are you going to fix that? Now you have to go through, well, again, we have to redesign it. Okay, well, how long does that take? And then how long does it take before you test it? And so now you've spent a bunch of money and you haven't proven out what you really need to prove out, is that you had a technology that works. So, if you have a fundamental, if you're going to fake it before you make it, make sure you're going to make it. This, make sure you've solved your key challenges, and true lean startup principles. These guys would have nailed that seal problem before building a bunch of units. And last one, Solar City. I could have done the first round of investment. I didn't. But I think this is an interesting comparison of Solar City and Sunrun. I don't know if you guys know these companies at all, but basically, solar panel cost was coming down, but it wasn't really being deployed broadly. And so how do you get that into people to deploy it? It's kind of an unproven technology. It takes a lot of capital up front. So Solar City figured out, hey, well, let's just deliver solar as a service. And they took kind of an aggressive approach, actually. Back then, the ITC, your sort of 30% reduction really applied to businesses, but not to individual homeowners. And so it was also an interesting model, because then they could go to residential customers and say, hey, we're a business. And so they're able to get that discount. So they did classic lean startup, went to farmers market, went to their neighbors, went to farmers market, door to door, and just started financing this. And so for no cost, you get solar on your home, or you could actually save money. And so that was they were a great success. They were growing. Meanwhile, Sunrun came along and they kind of did the same thing. So Solar City's customer was, you at your house. Sunrun took a different approach. They had a different customer, but they were selling the same thing. Their customer was the installer. So we'll just provide a finance solution. If you looked at this business in general, you could make money. There's money to be made, I guess, on find a customer, on install, and on financing. The most profitable place to make money was financing. And that's where Sunrun started. And so Solar City built out retail facilities. They had vans driving all over the Bay Area. They were going to do all that install themselves. People were going to show up to a retail location. Sunrun much leaner in terms of, and what ultimately the installation piece was not profitable. Money could be made on the customer acquisition and on the financing. Sunrun started financing, got into customer acquisition. Sunrun's a multi-billion-dollar company today. Market leaders. Solar City was bought by Tesla. A lot of people thought it was a bailout. Elon Musk's cousins started Solar City. There's a big lawsuit over it. But I don't think that's I don't think that's a big. I don't know the exact of Tesla, but when you look at what they're doing on solar, I don't think Solar City is a big business. The big win here was Sunrun. So it's just an interesting contrast of again, who's your customer? Solving the same problem, different companies, different customer, different models, different results. So this stuff matters even at your very early stages. I think that's all I have.
That's it. A question, David.
Yeah,
You said earlier about nail it before you scale it. What happens to processes where the scale up itself requires a huge amount of investment, like you have to demonstrate the process at scale? Chemical processes or other things that we are normally used to. How do we tackle that?
I mean, there's risk in scaling it, right? But most of the things that we deal with, you can prove out, you sort of prove out at, call it a scale of 1, and then you go to a scale of 20, and then maybe you go to a scale of 100, and then the true comes in, and that one may be little tiny thing in the lab, and now built out sort of your full integrated system, and now you've built sort of a larger system, and now you're piloting, and now you're going and deploying. So there's for a number of things, we know that those things scale reasonably well. I mean, I'd be curious in the ethylene example how
Mitigate that risk is partnering. As we saw some examples from the last lecture, even today with Futura, you partner with somebody bigger who can take some of that risk and provide some of that capital while you go with exactly what he said, 1 to 20 to 100 and then beyond. And some of it can also be done with modularity, where going from 100 to 200 is 2 100s, not a 200.
And to that point, with our startups, you also just focus on what you do. So, we have an investment in a company called Amovia that's in the producing ammonia better than the Haber-Bosch process. And then we have a company called Aether Fuels. These folks are partnering to focus just on proving out what they need to prove out in their area by partnering with someone else who can do the rest.
Partnering is a very good risk mitigation approach.
Could you de-risk that by getting an LOC maybe?
Getting a what?
Getting a letter of commitment, making the risk go on the customer instead of.
Well, many different ways of doing it. Partnering could be an OEM relationship, could be a true joint venture, could be them providing non-dilutive capital, or even owning part of the company. There's so many different ways, depending on the situation.
But there is risk. There's risk.
Taking the risk, whether it's a partner or somebody.
I mean, look at these fusion companies.
I'm sorry?
Look at these fusion companies. I mean, they're having to, prove things out at a little scale and key things, but then ultimately they're going to have to raise a tremendous amount of capital and partner ideally to get to that. You aren't going to know if they can hit the triple point truly until they actually deploy it. So some things like to your point, you got to sell the vision, right? That this is so big that there's money to be made by investors. So if it's not big enough of an idea and you can't step into it, and you do have to build a full scale system before if you get to your 150 million degrees for the right amount of time with the right density that gets your fusion reaction, like you gotta sell that.
And you need, for some of these giant projects, you need government. Grants, partnerships,
Absolutely.
DoD, DARPA, all of that. But anyway, thank you so much, David. Big hand for David. We're running out of time almost, so what I'd like to just go over is some after class assignment. Try to practice some of those interviewing techniques amongst yourselves. Now, you could be here all alone. You don't have someone else to practice it with, but most of you are more than one person. So go ahead and pair up with one of your teammates and practice a 5-minute discovery process using all of the interview techniques and customer discovery that we talked about earlier. Just a way for you to get it. As David made a very good point earlier when he says, a lot of this may be self-evident, but you don't know how many times people don't do it. 9 out of 10 is my guess. That's why 9 out of 10 companies probably, it sort of correlates with the failure rate of companies. But people just don't follow the basic principles that are self-evident.
We have a company we're evaluating right now, interesting technology, and our sense is that the CEO wants to kind of sit in a room by himself and figure this all out. He's brilliant, but he hasn't gone out and engaged with customers and likes the idea, well, we want to be in stealth and things. And our sense is that he's just not somebody that really wants to talk to the customers.
How many of you think you can pull this off? Take one of your ideas, which is your idea, the one you're working on, interview 2 potential customers, and do a 1 to 2 page synthesis along the lines of the 6 slides I showed you on interviewing techniques. How many of you think you can pull it off? Kumi can, Samantha can, you guys can.
At least one. We can.
What if I was rating you on it? You would do it too, right? Just because there's no grade doesn't mean you get away, right? How about you all? Think you can do it? Let's all give it a try, please. Trying in and of itself will teach you a lot. Not trying will teach you nothing. Finally, let's just write it up. This is the assignment for next week. Take your ideas, try it out on 2 potential customers, follow the classic customer discovery interviewing technique process that we've outlined, and you'll see it'll help you. And try to avoid the pitfalls of what we talked about. And the goal is to gain real world insight in the direction of the research that you're doing. Does it truly have a chance to become a company? Clearly, many of you do. I'm there. But you've got to go through the process and learn from it. And here's a reading list. Have you utilizing my reading list?
I listened to the podcast.
Okay, good. Did you find it helpful?
Alex LinkedIn one.
The LinkedIn one
Or the
or the Airbnb?
Airbnb, that was the one.
Yeah.
Sorry.
Please take notes. Did you listen to the Airbnb podcast, Reid Hoffman's?
I have before, I didn't re-listen to it this time.
You should, in the context of this, please do. I mean, I do research to try to give you good examples of what you should read and listen to. I mean, I guess it's falling flat. But anyway, there is gold in Dendar Hills, as they said, back in the gold rush days. There's vignettes of really good information that'll help you in your attempt to become entrepreneurs. That's it for now. See you next week. Thanks all. Right on time. 12 minutes.
Thank you, Ashok. Okay, if you have any questions, we can take up for a little while. The creatures are still coming. So don't lose hope. I don't know why they are not able to find us. But anything for Ashok or for Chevron Ventures, David?
They're exhausted.
I guess for David, how have you seen the number of innovations like ramp up since 30 years ago now? And have you seen like companies take on ideas at a junior stage as opposed to like the fully developed, you have a whole company you're basically acquiring?
Is this for Chevron Ventures or general?
Just in general, like with your background.
In climate specifically.
Yeah.
So there's way more innovation and ideas and focus. There weren't classes like this. There weren't teams looking at opportunities back years ago. There wasn't, it's I would say the level of innovation is and mindset is an order of magnitude at least higher in this area. I mean, back then, I mean, frankly, when I joined, in power, there was Kyoto, but nobody was really talking about climate change. It was very controversial when I remember years later when somebody declared that climate change is real at a conference.
Shell was the first to do so once the big companies. Shell said, yeah, we agree. John Hofmeister remembered his speech. We agree. Climate change is here and it's real. I think it was like 2005.
So some of it was, honestly, some of it was, I was a little bit more power market focused. So, deregulation was happening. Look, deregulation happened in the telecom industry, and look at all the innovation deregulations happening here. That's going to create opportunities. And certainly, solar was totally unclear that that was even going to be economic. And so, the renewables were just coming on basically. So it's changed quite a bit, and ideas around, I mean, hydrogen was certainly around, and some folks were talking about it, but people, not much investment in that area. Carbon capture, utilization, DAC, none of those things. Nobody was really looking at that. There was some sequestration stuff, but not much. It was really about solar, wind, some batteries for sure. You know, Tesla, ultimately, a lot of those companies weren't successful. You know, there's
Solyndra, remember Solyndra? $1.2 billion investment, half of it from the US government, or maybe more than half.
so what happened is a lot of money went into solar, and then the Chinese basically took one on solar, and then in the US really just first solar. A lot of big push on sort of CIGS and different sort of, that's what Cylinder was doing. So yeah, it's totally different and ramped up. And then, you know, clean tech 1.0, it sort of died. You know, a lot of the climate stuff came more to the forefront. Certainly, advancements. I mean, the big successes, just broadly, you know, solar is the cheapest form of power on the planet that you can get. That's remarkable. Wind has still can come down in cost. Battery technology is remarkable. EVs, I mean, the amount of change in those like 20 years is massive change compared to, you know, previous time periods. So, yeah, big change. And I think we're going to continue to see a lot of change.
Yeah, but in general, the investment climate is tougher today than it was a couple of years ago. Angels, VCs, private equity are being far more cautious, demanding far better valuations. It's a difficult time right now for young startups to go out and raise capital. That's why lean startup is the way to go. And the climate will change. I mean, consumer confidence is down, particularly down over the last 6 months. And a lot of it then translates back into the investment climate too.
There's 150 DAC startups, right? So that there's some areas that just had a lot of companies funded. That's still an interesting area. We invested in carbon engineering. We actually got Oxy purchased that, so we got a nice exit on that one. But you know, that's an interesting area still. Some folks are doing DAC and point source kind of together. You know, I think it has to be pretty good.
Yeah, a good idea, a solid business plan with a real chance of having a market will still get funded. But again, you know, coming back to a really solid business plan that backs it up.
Meaning it has to be way better than, you know, what's out there today. And you have to be in a good position versus competitors, and you have all this stuff we talked about today. You need customers that want what you're providing.
All right, Radha, where are we on the pizza for these people?
Yeah, well, yeah, your background is coming right background. Honestly,
I want to have talk to how it's like, free energy is the key to everything. What's your thoughts on that? Do you really see that coming to life in the near future?
So I would say one, there's not a Chevron view. This is the case for a lot of things. There's different views within Chevron. We've invested in that area. We think it's an area of high potential. It's sort of we need all solutions type thing. So I expect nuclear is going to play a role. Having said that, it's not easy. We don't have a permanent waste place to put waste. The nuclear navy, the technology is amazing. It works incredibly well. It's very safe. It's been safe. These things are going all over the oceans. It absolutely can be done safely. Can it be economic? I think that's the big challenge, and that's why it's still a venture investment, right? So that there's a lot that has to be proven out. I think the Gen 4 technologies provide advantages for safety and cost. If you can get around some of we won't go into it, but yeah, it's an area of interest, but it's not easy.
If you were to put a time frame on it, your personal opinion, when do you think it would like really start to gain traction? Is it like 20 years, 15 years from now?
I don't know if I should publicly say it.
You say over 20 years, over 30.
I think opinions vary. Yeah. So I'm probably more, there's a lot of, where's the best place so small modular reactors, this idea that you can make this thing smaller and productize it and reduce the cost of it and, not have these huge project overruns. I think that's a very viable concept. There are places in the world where nuclear is being deployed. If that's really a much better way to do nuclear, I would love to see that work out well in France and China and India or wherever. Trying to get nuclear commercialized in the US just creates a lot of, you got to get through the NRC, and then you've got to get local communities to buy in. And there's a lot of challenges. Having said that, there are pathways. The investment we made in Radiant, that's sort of a smaller reactor. I think there are applications that look kind of, interesting more near term, but I still have a little bit of if you can have renewables, and those are super cheap, you can complement those with load. You can have rate reform. So, and you need better wires and better connectivity. You can send the power. Then you can sort of, and then storage fits into it. That sort of architecture with renewable storage, like flexible load, sort of virtual power plants, and then complemented with natural gas, which is a technology can ramp up and ramp down. That's who you have to compete against, I think.
Yeah.
And that can be, and then with natural gas, that's where some of the carbon capture stuff can fit in. So what's your opinion?
Well, it's not my field of expertise, but I've always been interested in it.
And then,
Yeah. I don't know enough to really say much. But I mean, I've been watching some videos here and there, reading some articles here and there, and I always get the sense that like that's the ultimate goal of energy that we're trying to reach. If we can unlock that, then nothing else kind of matters.
Yeah, the fusion folks that you'll talk to, some people will say it's 20 years. Some of the fusion folks are gonna say we'll have it by the end of this decade.
Yeah,
And the fusion folks will say you'll have fusion reactors before you'll have fission reactors.
yeah, I've heard that.
So that's possible. I mean, we don't know, right?
Yeah.
That's why it's venture capital.
But this idea you mentioned of having it like a modular thing is interesting, because yeah, you're right, building it on this huge commercial scale is very challenging, but if you can somehow use it for smaller things, maybe that's how you gain entry into the market.
I mean, the first company I looked closely at the Series A, and a friend actually got the company going that was out of his university, New Scale Power. And these guys have an RC approval, but that was more geared towards, hey, you're gonna build a 2 gigawatt power plant.
Yeah, yeah,
Why not build it with a bunch of small reactors?
yeah, exactly.
And isn't that a better way to do it? And then you're refueling constantly. You're not taking it, so you just go from one to the other. You get efficiencies on that. You're not bringing 2 gigawatts on all at once. You can start with 300 megawatts, and you can add another 300 megawatts, and you can add another 300. And, it's not a big engineering project. So I don't know. You're probably familiar with Oakley, and I can never say it right, but the plants in Georgia, the two CP1000 or whatever. That took 37 billion, and it was originally under 10 billion.
Yeah,
So that's the traditional nuclear.
yeah, very just.
So there's not a lot of financing or support for those type of plants right now. I mean, some of this is getting relooked at with Microsoft and others looking at, getting 3 Mile Island back up and running. So I don't know. That's why it's fun.
Yeah.
My family's all from Harrisburg, so they're all
Okay.
not from
Yeah.
my family works there.
Yeah,
While it was running, but apparently Microsoft has purchased it, so
yeah,
we'll see. But one of the nuclear reactors, the one that fused together, is still there, so that will be interesting to see what they can do.
yeah. Yeah.
Chevron invested in fusion at all?
We're in a company called TAE, and we're a company called SAP.
Yeah.
I looked really closely at Medox. I'm sure you're familiar with.
Yeah.
We've looked at other companies. There's, some of the Stellar it's really interesting. But, there's part of why we invest is getting sort of a strategic insight.
Do you worry about verticality?
Verticality.
Or investments, like if you're investing in fusion, would you invest in, or if you invest in it, let's say in an entrepreneurship context, do you try to verticalize as much as possible in investment?
You're saying, will you invest in HTSCs because they're gonna be used by fusion?
Sure, like that, yeah.
Yeah, I mean, absolutely. That you have to